Let's talk to Marc Ostwald. He's a strategist at ADMISI. Very good morning to you, young Mark.
Good morning.
Right, in terms of this week, the US politics and lots of economic numbers, what's your overall?
I think the numbers that we've had this week, the CPI data basically were bang in line with expectations. So there seemed to be a fraternity out there sort of saying, actually, they weren't bad. Let's just sort of back up a moment here. Sure, they were bang in line. Headline 2.2, core 1.8. That's nothing for the Fed to really worry about, except when you start looking at the 6-month annualized rates, because they're still being pulled down by what happened in the period between March and June of last year. So if you look at the 6-month annualized rates for the most recent 6 months, headline CPI is actually 3.6,
Right,
which is probably a good indication of where it's going, and core is 2.2. So it's not quite as benign as people think. Retail sales, clearly disappointing. We've got industrial production data where we're hoping we're going to bounce back. We were hoping the retail sales were going to bounce back, but they didn't. Certainly industrial production, you would expect to bounce back given manufacturing surveys in the States are pretty gung-ho about the US economy. But I don't think they're going to actually make a material difference to what we get from the Fed next week. So it's interesting to have a look what we've got in terms of expectations. That chart of or table of market expectations on rate probabilities, we've got a 97.9% chance allocated to a 25 basis point rate hike next week. That's baked in the cake. We're at 68% for June. That's pretty much baked in the cake. Not 100% certain. It's what happens thereafter when one's looking at the back end of the year in terms of market expectations of will there after June be one or two more? And their markets are somewhat ambivalent as to what's likely to happen. Obviously, it's a long way between now and then, and a lot of things can happen in markets, a lot of things can happen in economies, and definitely a lot of things can happen in politics, because the one thing which is being clear for this week is we sort of look at the economic data and then along comes another political surprise, be it sanctions on Putin, be it this cozying up between Five Star and Lega Nord in Italy, be it the Mueller subpoenas related to Mr. Trump's finances. We're always good for a surprise, and it's that sort of. There is a conundrum for financial markets at the moment, insofar as the economic data broadly, globally, are good. Okay, there's been the odd disappointment, but broadly good. The corporate earnings haven't been bad. And there's a lot of money around. A huge amount of money. There's all the excess central bank liquidity. There is additionally the buyback monies that we're going to be getting over the next 6 months. There is a surfeit of savings in the world, all hunting around for opportunities, and that puts the fund managers under a lot of pressure because the wall of money is there. So going defensive is always a bit of a hazard, and still sort of fosters this fear of missing out. And then a political idea comes along and says, yeah, but you sure about that? Are you sure you should be fearing about missing out? So the dot plot that we get next week will be very important. I think people won't be surprised if the Fed has a 4 rate hikes this year dot plot, but it'll be what they're looking at for 2019. Which is perhaps most important. Obviously, that's not on that table. And the key thing here is the market's only pricing in basically 1.5 rate hikes, whereas I think the Fed's looking at probably 3 rather than 2. You have to always ask yourself a question with that. Are we bearing down on these longer term rates simply because there's so much money chasing assets? And as long as that's there, and this is so far away, we're talking about 2019, people are going, yes, but I can get. And in the meantime, I need to park some money in what I would call defensive areas. So I'm going to buy that, even though I know that maybe what's assumed in terms of a longer term interest rate perspective isn't quite right. So it's a wall of money there. So on the other side of this equation, if we go to the next chart, is this much discussed thing about the LIBOR, which is the unsecured lending rate in the States, and the OIS spread, which is the secured lending rate. Now, it's spiked up, as we can see, very sharply recently. We're at the sort of levels that we were in 2016.
So this is the difference between secured and unsecured lending in the States. Okay.
Unsecured is to some extent largely irrelevant, because unsecured lending nowadays is very much not what is done, simply because of the regulations that we have. So the pressure here is not coming from credit concerns. The pressure is actually coming, above all, from the rise in T-bill issuance in the States. We've talked about the budget deficit in the States before. We know it's going to go up substantially. A lot of it is being funded at the very short end. Thus, 3-month bill issuance, which in early January was somewhere around 10-15 billion a week, is now 60.
Right.
Little surprise that we're getting some upward pressure there, and little surprise actually for the banking sector that they're going, well, we're going to start issuing more commercial paper. And that's what's pressurizing this upwards. For the time being, I don't think it actually plays out in a negative way on one condition: the dollar stays weak. Were the dollar to rally, then suddenly the financing of leverage positions, the financing of carry positions into emerging markets, the finance of leverage positions in any market you can care to think of, will suddenly have to pay attention to this, because the financing costs are rising. So you could, at that point, actually see quite a sharp snapback or upward move in the dollar, because suddenly people will be rushing to do that. Other factors contributing to it also are quite a lot of repatriation related to the tax cuts, and indeed a lot of onshoring of what was previously offshore dollars. That's effectively related. So it all plays in. For the time being, it's something we need to keep an eye on, rather than going, do we need to panic? But it's going to be an interesting one, and it's certainly going to be interesting insofar as next week we've got that Fed meeting, and that could be a fairly decisive moment for markets, even if I wouldn't expect that to necessarily play out too sharply ahead of quarter end, because people will be more focused on quarter end, long Easter holiday break, which is generally pretty dampens activity in markets. But for Q2, it will become much, much more important.
On that note, Mark, we've run out of time. Fascinating stuff. Thank you as always.